Today we're going to talk about the iCAPM. In your book, it's described as the CAPM, Capital Asset Pricing Model. The I stands for an international. We'll talk about that in a second. We're going to begin our discussion motivating the whole thing on correlation and diversification. We're going to go back about systematic risk. We talked about this when we first divided risk in two. Remember that we talked about standalone and market risk. So then we're going to talk about expected returns, security market lines, an efficient frontier, and then we're going to go back to some pitfalls on Excel. So let's talk about creating a portfolio. We did this in class, and we saw a little bit of magic, right? We saw how after we added 3 stocks in our portfolio, the expected return remained constant, but the risk of the portfolio went down. However, the diversification benefits tend to dissipate at about 10 to 20 stocks. So graphically, we can see this like this. As we add more shares, more stocks to our portfolio, the standard deviation of the portfolio starts to go down. So from 35%, that was the average that we talked about per year, go down to this, but eventually we get to something around 20% for the US. That is a risk that we cannot get rid of. We call this the market risk or systematic risk. This over here, this difference between this and that is the diversifiable risk. So there's no reason why we should bear 35% when we could, just by adding more stocks to portfolio, get to 20. However, this is the minimum risk, that 20%. The interesting thing is this. If we look at an international portfolio, the line on top is the portfolio of US stocks, and this changes all the time. So for example, in this chart, instead of 35%, we're talking about 27%. If we use a portfolio of 20 to 30 stocks that are international, we can get that risk all the way down to 11 or maybe 12%. So remember these two slides: domestic, just US, international. Where would you want to be? This is why no finance class should be taught without the international part of it. So let's go back to this. The standalone risk, where does it come from? Well, there's a market risk and a diversifiable risk. So every share, we said, had some risk that we cannot do away with and some risk that is diversifiable. So the market risk is the equivalent of the risk you have to bear just to be playing the game. If you want to go to the casino, you want to sit on the table, you gotta bear some risk. You don't have to bet a lot, but just if you want to see cards, you're gonna have to pay something. Well, this is the risk you have to bear to be in the market. Diversifiable risk is what you can eliminate through diversification, as we saw in the charts. Now, if an investor doesn't diversify and has a one stock portfolio, should this investor be compensated for the extra risk they bear? No, not at all. Nobody should do that, and nobody should get compensated for doing something that doesn't make any sense. So, an investor with a one stock portfolio or a two stock portfolio should not get any more returns, should not get any compensation for holding this risk. Now, if the only risk that matters is the risk that is systematic or the non-diversifiable risk, well, how can we measure that? Sharp, an economist in the 70s, came up with a model saying that, well, basically the only thing that matters here is the return of my stock or the volatility of my stock compared to the market, to a market line, to a portfolio with all the stocks that we can imagine. And he came out with this, what is called the security market line, which is an equation that the return on a particular company, let's say Apple, is the equivalent of the risk-free rate, the return that an investor will get in government securities, plus what we call a risk premium, a return on the market minus this risk-free rate multiplied times a beta. and we're going to get in a second to what this beta means. But the market risk premium here is, well, what the market will get invested in all the stocks in the market, which as we have seen is, I don't know, around 8 to 10%, and this varies all the time, minus this risk-free rate times this beta. So the main conclusion of this model is that the relevant risk here is this concept of beta. This beta, we're going to see that measures the reaction of my company, company I, Apple, compared to the market in general. But what is this well-diversified portfolio? What is this market portfolio? Well, it's a market portfolio that should measure everything that is made in an economy. The question is, we typically use the S&P 500, which are the top, biggest, largest 500 companies in the US. Obvious question is, well, why the biggest 500 company? What happened with the next one? So some people say, well, we could use the Russell 2000. Actually, Russell is with two S's, which is an index that based on the 2000 largest companies after this 500. So maybe, well, that makes more sense. But the biggest question is, why not a world index? Why not including in this the stocks of China, the stocks of Singapore, the stocks of South America, Africa, Europe, etc.? And the bigger question here is the one below. Are financial markets integrated or not? If an investor could easily go and invest in South America, in Africa, in Australia, in Asia, well, the relevant market for him or her should be the world market, and this ACW is an index that measures world returns. And given what we know, the financial markets are pretty much integrated, but stubbornly many analysts in the US still use just the S&P 500. We'll see more about how to calculate betas in a second. Let's talk a little bit more about them in theory. So the security market line is something like this. This is right from your book, guys. So we have a line here that has a particular slope, right? And here we have at the zero, so risk zero, and a particular return, we have the T-bill or the risk-free rate. So if you don't want to bear any risk, you can get 3%. This is the example, right? So 3% if you don't want to have any risk. If you want to have a risk of 1, which is by definition the market, you buy the stock market completely as a whole, the S&P 500, the Russell 2000, whatever we define the market is. And these 2 points give us a line, which is the security market line. Now, with this tool, we can say, well, where these companies are they on the line or above the line? If a company is above the line, well, for this particular risk, it's giving me more return. I will like that. So this is the security market line, but make sure that you see here that this is beta and this is return. So beta then measures stock market risk and the volatility relative to the market. It indicates how risky the company is if it is held in a well-diversified portfolio. I'm going to go back to the other slide, and that beta here is nothing but the slope of this coefficient in this line. If you guys remember the equation of a line, this is it. Now this beta can be calculated. This is the slope of this line, basically. If beta is 1, the particular security is just as risky as the average stock. If the beta is bigger than 1, then the security is riskier. If the beta is less than 1, the security is less risky. Most stocks have beta between 0.5 and 1.5. Some of them are much higher than that. We'll see some examples. An interpretation of this is, let's say that, and I'm going to go to an example here. If beta is 1, like here, if the market goes up 1%, it means that your company is also going to go 1% up. If you have a beta of, let's say, 2, when the market goes up 1%, your company is going to go up 2%. Does it make sense? So this is what the beta is measuring. Can the beta of a security be negative? Yeah, sure, but it's not very likely that we'll find a negative beta. We may find it given the weird companies that we chose for our examples. We'll see once we calculate them, but it is something rare. Another chart that will exemplify this, and in this case we don't have betas here, we have standard deviation. So okay, so standard deviation, and we have returns on the y-axis, standard deviation on the x. Imagine that all these dots are portfolios or actually companies. If we put all companies possible, all combinations of these companies, we're going to get a number of dots here, and we could actually make a line right here, the one that I'm overshadowing, that it is the efficient frontier, meaning like there's no other portfolio here that gives you a better combination. So for example, this company has the highest return at the lowest risk, and same for this one. You see that, for example, this particular company right here is not as efficient, and this one gets a lot more. So we would like to have portfolios that are like right here. Okay, now oops, the definition of this one is not very good, but then remember the other line that we had from risk-free to this tangent to this efficient frontier. It gives you a line of possible combinations. You as an investor, and this is something that you guys are going to learn in your investment class later, you can be at any position here. The point of me including this chart is that when you have an international portfolio, not only of companies in the US, your whole efficient frontiers move up and to the left, meaning you create portfolios that have lower risk and have higher returns, meaning that your line here, your tangent point, the best portfolio possible is going to be a portfolio that has lower risk and higher return. What's not to like about that?